this is Editor's Take. I'm Sakshi Batra and I have with me Gaurav Chaudhary. He's the Deputy Executive Editor of Money Control, and we are here to talk about the latest macroeconomic data released by the Commerce Ministry on Friday after the market hours with respect to the exports and imports. Thanks very much, Gaurav, for joining in. Now tell us, what does the latest trade deficit data really tells us?
Well, what it does mean is that there are two factors at play. One, there has been a drop in gold imports and gems and jewellery,
right.
And also there has been a base effect that has been at play. But what it does tell us that if trend holds, then probably the current account deficit is not going to be as bad as it was made out to be. But it needs to be seen how crude prices actually play out. That's the known devil there, and we need to see how actually crude prices play out in the next 3 to 4 months, depending on what the OPEC cuts actually mean for India.
Absolutely. And for the benefit of all the viewers, let us first share with them what the data really tells us. The trade deficit has actually narrowed to $16.7 billion in the month of November, whereas in October, if you see, trade deficit was at $17.13 billion. And just now, how Gaurav pointed out, there were a lot of factors at play. For example, there was definitely a lower down of the gold imports at this point in time. And also, would you say that the crude oil prices also falling down have
Correct, absolutely. The crude oil prices had fallen by about 30% in October, and we had seen it fall from above $80 a barrel to less than 60 a barrel, and clearly that has had an impact on the trade deficit, at least in value terms, because crude oil imports constitutes a very large portion, accounts for a large proportion of our total trade import bill, and if that price falls, clearly there is a direct impact, and that is showing up in the trade deficit. But having said, in the month of December, OPEC has decided to go for a production cut, although higher production in the US is going to cap the impact, one would believe so, and there's a global slowdown, so the demand for crude oil is going to moderate a bit. That could help India so far as the oil import bill is concerned. But as I said, we need to see how crude oil prices play out in the next couple of months. If it remains stable, that's good for India's trade deficit and current account deficit.
Absolutely. And trade deficit numbers actually coming down right now is it good news for the economy?
At least so far as the foreign exchange management, reserves management is concerned, and so far as the rupee is concerned, current account deficit at one point was looking like it's going to close in on around 2.9 to 3% in the September quarter. In fact, it had hit 2.9% of GDP, and but what has happened since then, and especially in crude oil prices, and also a drop in gold imports, probably suggests that we should be able to contain the current account deficit around 2.5, 2.6% levels of GDP. While that is high, it's still almost nearly half of what we had hit in 2013 because of the taper tantrum when it had hit 5% of GDP. But that said, we need to keep a close eye on the current account deficit because it will have a direct bearing on which way the rupee is moving.
Exactly, and that's very important what you pointed out. Actually, current account deficit did hit a 4-year high in the September quarter of 2.9% of the GDP. And likewise, definitely this is a big relief. Trade deficit lowering down in November, in the month of November. But what is your outlook on both of their front, both of the trade deficit and current account deficit front? And do you think trade deficit coming down will also somehow balance out the negative impact of the current account deficit?
There are two sides to the equation. One is the import side, and import side is something that is clearly going to be dominated by crude oil prices and their behavior. But something that we need to really focus on, and which is within our control, is merchandise exports. We need to keep in mind that merchandise exports are actually moderated to growth in merchandise, moderate to 0.8%. That is something that looks a little worrisome at this point. Please remember that since 1992, when we opened up our trade, our merchandise exports as a share of world trade has only gone up from about 0.8% or so to just about 2%. So that is something that we need to keep in mind, and clearly merchandise exports is something that is only going to help. If growth in merchandise exports happens, it's only going to help the current account deficit, and probably a reset in the US China trade relations also throws up an opportunity for India. because there is a window which India's merchandise exports can really exploit.
Right. Thanks very much then, Gaurav, for sharing all that insight with us. But so far, if you see, the trade deficit number is definitely good news for the economy. What remains to be seen is how we move forward, because the crude oil prices and how the gold imports also shape up in the coming months will definitely define how both of these twin deficits really, impact the economy going forward. Thanks very much for joining us in this edition of Editor's Take, and do stay logged on to moneycontrol.com for more news and updates. Thanks for watching.